Hi, this is CF Liu. Now, welcome back to CF Liu channel. Now, in this lesson, I'm going to walk you through how we're going to actually dissect Al-Akhar Healthcare REIT annual report. Now, this annual report is 2018, so let's get right into it. So you can see that over here, this report is actually 158 pages long, which really we don't have to actually read each and every word. So I've actually bookmarked a few pages, which I think is important. Al-Akhar Healthcare REIT, Real Estate Investment Trust, as you know, is the REIT, Real Estate Investment Trust, that actually holds almost all KPJ hospital. Let's put it that way, right? So if you are not familiar with real estate investment trust and all that, so you can actually, if you are not a member yet, you don't know what is a REIT method is about, so you can just head over to what is below there, reitmethod.com. But more so, I'm going to really walk you through of which pages and what are the section in an annual report of Malaysian REIT, taking into example Al-Akhar REIT. Now, if you want to check out other example, just this at the end of this lesson, this video, there will be, I've actually dissected Axis REIT, Hectare REIT, and also what have that a few of them like IGB REIT and all that. So you can actually check that out if you have not already after this video end. But in this video, I'm going to dissect and walk you through what are the pages, what are the section inside annual report for Al-Akhar Healthcare Real Estate Investment Trust. Is 158 pages, so you don't need to go through each and everything of this. For example, this one and all that. So let's get right into it. Now, the first page, which is Al-Akhar Healthcare REIT, actually sum it up quite good, is because they have a record from 2014 to 2018. Now that's pretty nice. You can see at least you can see a medium-term trend, although this REIT was listed in 2006. So it's been more than 10 years, but just to give you a perspective of the past 5 years, of the most recent 5 years, including the current year in the annual report, is good. So you can see that what I've highlighted over here is that this 2014 2015, the gross revenue keep on growing, but then actually slowed down in 2016 and slowed down again in 2017, and then in 2018 it's slow. It actually bumps back up. So what happened over here? So we look at here, look at if we can spot any clue in terms of if you are new to this, or you have not invested yet, then you really need to drill back to this and look for any clues. The first kind of so-called detective work you need to see. But if the current annual report really does not give you any hint, and you have no idea what has happened, imagine this is your first time encountering real estate investment trust and you want to invest in. So before you invest in, it's actually very recommended. I would recommend you actually not only read the most current annual report, you also want to read what has happened for the past 2-3 years, the annual report. Now there's no shortcut to it. If you really want to know what's happening so that you can make the best informed decision, that is the way to go. Now that being said, let's just take a shortcut over here and look what has happened. So you can see in 2015 to 2016, the investment property, right? Because the most of this revenue by a real estate investment trust or REIT, it's 90% or more are all rental income. So rental income comes from investment property, right? So all other things, all other income or revenue are insignificant compared to the rental income, which is, again, I stress this again, generated by investment property. So investment property, as you can see over here, now it's expandable because what I remember is that they have sold off one of their property. It's not because their property portfolio value actually decreased. They've sold I think at least 1 or 2 property off, that's why it decreased. So it makes sense if it decreases, okay? And but for here it actually increases the property value, right? So they should have more property or same amount of property, but yet it, you know, it decreases. So you want to actually look at 2017 the annual report, what actually happened. Now if you look at that and you are really serious to look at what are the reason why there's an increase in the property value, or the maybe a property number of property inside this Al-Akhar REIT portfolio, but yet the gross revenue actually decreases. Look at that, see if you can see any clue. If you can't, just come back to this video and, you know, just ask your questions and, you know, all that. So but that being said, that is a past already, and in 2018 they have a slight increase in property value, 1.11 actually 1.459 billion and 1.485 billion, and then the gross rental also increased accordingly, as you can see over here. So that is generally a good thing. So I really like the format. Now any REIT annual report that gives you a snapshot of what it has happened for the next 5 years, rather than just compare 2 years like 2017 and 2018, like just the most recent year and the year before that. It just doesn't really give us give us a perspective, doesn't really give us a mid-term trend. But if any annual report that actually tabulate this in this manner, I think I give it a thumbs up, right? So moving on to next. Now normally this is actually displayed in the end, the end part, the final part of the annual report, but they choose to actually demonstrate this in the page 16 of this annual report out of 158 pages. Is that you know that Lembaga Tabung Haji is the major shareholder, EPF is the third major shareholder, and then these are your pension fund in Malaysia, actually the second most shareholder. So I've always make it a point to say that you want to invest into any stocks or anywhere, you see whether there are big boys actually investing into it or not. Now we are not talking about following what people invest. We are actually doing some critical thinking or analysis or due diligence on our own. But you know that when all these big guys become a big major shareholder of a counter or a stock, you know that you can't go wrong, because whatever due diligence that we are doing over here, they would have already have staff and analysts that have done their part also, and that's why they are actually holding this major ownership in this REIT. So in this case it is safer, but again, this is not a recommendation to buy or sell. If you understand that and you know that I have nothing to gain or lose by you investing into this REIT that we are analyzing over here, click like below and let me know what are your comments and all that. So moving on to this, now it's always important if this is the minimum. I know a lot of people do not like to read annual report, but the minimum you want to read is at least on the management discussion and analysis of management report. So what happened is you want to look at net property income, as you can see over here, compared to 2017 2018 there's an increase. Now just be very aware to say that how they tabulate this is actually different from one REIT manager annual report to another real estate investment trust manager. The way they tabulate it, some people some might be tabulated in a sense the most recent year will be on the left. So for this, it is follow the conventional way where we actually write our whatever words like from left to right. So just be aware of that. Don't get yourself confused because you are reading a few annual reports. Some of them will actually put the most recent year on the left, some of them will put on the right, so don't get yourself confused. So let's move on, and this is the thing. Realized profit increase 2.0%. Why there is a slight increase in this profit is or rental, because there's a new rental income contributed from the car park block at KBJ Selangor Specialist Hospital, which was acquired in December 2017. Okay, and a modest rental revision for 2018, but partially offset by higher financing costs due to refinancing exercise. So you know that when they refinance, there's an additional cost. So actually that that actually pulls down the increase due to their new contribution of rental income from the new car park, which are newly acquired and all that. So contributions by segment, you know that if you don't know that already, at the time of 2018 or 2019, our Arca REIT, normally REIT they only hold asset in Malaysia, but for our Arca REIT they also have one retirement home in Australia. So moving on to here, and we can see that Malaysian segment they contribute certain, like on Malaysian segment they actually break that up. Most of them the revenue is still come from Malaysian segment, all the KPJ hospital. Less than 10% is contributed by the Australian retirement home. So this is something. And when it comes to Australian retirement home, I think there's a certain risk. It comes to this foreign exchange risk over here, so you just need to be aware about. So financing activity, what happened here? Operating activity, which is lower, is maybe settlement of a deferred consideration, blah blah blah. So operating activity, you can see over here. Investing activity, payment of land amalgamation, which converted is land to lease or freehold, offset by income received. Okay. Not very much. Finance activity utilized 51 million successfully. Refinance the Islamic medium-term note. So medium-term note 5 to 10 years. Islamic meaning because it's sukuk, so it's Sharia compliant. Note is a bond, so you can see that it has a fixed interest rate. So if you are bond, they provide, this is what we call a fixed borrowing for a bond. Bond is always fixed. But after the bond mature, they have to refinance it at a prevailing rate, and that could incur additional costs at that point of time, and also up from there, because when you refinance it at that time, the interest rate or whatnot was being offered. You have to take that based on the market rate. If interest rate generally have increased, you have to increase, no choice. So that being said, see that the amount to obtain Islamic financing, amount, issue price, settle, okay, balance, equivalent, okay. Not much over here, but just to let you know what is happening now. Okay, over here, investment property, as of January, foreign exchange differences, as you can see, why they have Australian property, so there's a foreign exchange risk. Gain of the property, gain of fair value, meaning the property appreciation. Enhancement, we are talking about the asset enhancement initiative, something they do, a REIT manager do to actually increase the value. You can see these are the value of this, and then the Australian one is called Jetta Garden Aged Care and Retirement Village over here. So moving on to next, operation review. Despite the challenging operating environment, the manager active asset management contributed to strong operation performance in 2018. 100% occupancy. I don't see why hospitals should not be 100% occupancy. Again, I have not, when the REIT manager always see that, because always say it's a challenging operating environment. I have not really seen manager that admit or to boost that say that it's an easy operating environment. There are tenants that actually are queuing up for 3 kilometers just to want to rent our tenant. So it doesn't really, no REIT manager has I've seen say that. But that in relative to, let's say, office REITs, right? That healthcare REIT is definitely more resilient in terms of occupancy, rental income, and all that. I will explain why in a second. But still, they say it's very challenging. But don't take their words like just as a face value, because when a REIT manager says that a healthcare REIT manager say it's challenging, actually it's not. Okay, maybe it's challenging within some competition between if there's a competing REIT and all that, but when it comes to healthcare REIT or whatnot, there are certain type of REIT that are pretty resilient. They are not really so affected by the ups and downs in the economy, right? Because hospital, people still need to go to hospital, to private healthcare, compared to when a REIT manager that actually talk about challenging environment for an office REIT. Now you need to take this seriously, because office REIT, it's really, they are having really a true challenge of oversupply and all that. And why I say healthcare REIT is resilient, because as you can see, I've covered in the cost for those of you who are already a REIT method member. So 15 years with an option to renew for another 15 years. So 5 rental term of 3 years, renew every expiry of the term. So they have a list of 15 years, every 3 years. Every 3 years they will be renewed. So I'm guessing that when there's a renewal every 3 years, out of this 15 years, there's at least 5 cycles of rental high or positive rental reversion over here, which is good. So you can see that the resiliency also comes from this factor. Now moving on, the healthcare sector, according to the REIT manager for this our Capige REIT, it also says the emergent mega trend in healthcare offering, such as mobile health and personalized treatment, may shift the way traditional healthcare provide operate within the near future. They are very far-sighted. Okay. Additionally, the expectation of continuous improvement in quality and standard of healthcare service in driving the increase in the competitive industry among incumbent operator. So you can see that they acknowledge that even, I think they also mentioned somewhat about the e-commerce, right? Let me see. Okay, they did not, but they did, right? The healthcare sector require technology strategy to adapt to disruption, especially from e-commerce sector. Okay, so even healthcare rate, they are not immune to, according to them, they are also not immune to this e-commerce and all that. Now moving on to next, this is the one I want to move on to next. Okay, hold on, this one. Okay, the gearing ratio. Now if you see any REIT manager that has a gearing ratio of more than approaching 40%, you know that their ability to actually raise capital is limited. They can do private placement, which is better because it's not so dilutive, but if they do a public placement, right issue is very dilutive. Now for more details on this, you just have to, if you're a REIT method member, there's a module in the mastery section that says a lot about this. But if you are not a member yet, so I have actually a module inside my full-fledged REIT method course. So if you're interested to join, this is free for you to explore. You just need to enter your name and email. Just go on readmethod.com over there and just register for an upcoming webinar to see whether this your cup of tea or not. But going back to here, you know that the only way for them to actually do is equity private placement, which is not favorable because retail investors don't like it. The other thing is they can do a so-called a bond issuance. I mean, one of the worst thing to do with a perpetual bond, but I don't think that's the case because they already have this kind of Islamic bond, which is IMTN, in Islamic medium term notes. That is actually a bond which have a fixed coupon rate. So they're actually borrowing money. Who are the pumping in the money? The institutional investor, the big investor. So in return, they actually borrow this money and they pay a certain fixed interest rate to their investor, to their bond holder, so-called. Okay, so their ability to expand will be severely limited unless they do some capital raising and all that. Okay, so return made for disposal of investment property. Now you see that they in 2017, just by this sentence alone, you know that in 2017 there's a disposal of investment property, which explains why, also I think it may be explained why. No, I think 2016 they have a decrease in asset value, but not 2017. So sometimes what happens is they dispose of one property but they buy two properties, so the effect is already being offset. So the entire portfolio value might have not changed a lot, but actually the type of property composition actually changed because there is a swap in terms of property. Some of them they let go, some of them they buy new, but plus and minus it could be still the same. Okay, so moving on to here, this is the one, right? This is pretty interesting. You can see what's happened on the group. Now I have not really seen any REIT manager listed what we call security commission fee or annual listing fees, which is pretty interesting over here. Security commission fees cost actually not much, okay, but anyway they still listed over here, so I wasn't really aware of that. Okay, so important section is always the comprehensive income, also the what we call as asset and liability statement of financial position. You can see the asset over here, What else? What else is important? This one is a bit a little shorter. Now you can see the management fee for a healthcare REIT. The base fee for REIT managers, for a healthcare REIT manager, at least for Al Arca Capija Healthcare REIT, is 0.1%. So you compare that with, let's say, IGB REIT, that is 1.0%, right? 1.0%. But for here it's only like, you know, under 1 billion only 0.1, over 1 billion 0.125. Okay, so make your judgment. What do you think? Whether, you know, for a retail REIT manager, actually their base management fee actually 10 times as more than a REIT manager for a healthcare REIT. What do you think about that? Comments below. Okay, comments below. And then there is no performance fee. You know that for IGB REIT there is even what we call as this a performance fee. If I could actually open back IGB REIT and just, you know, just let you see what I mean by that if you haven't watched that video. Okay, this video I talk about IGB REIT, right? And you know that for IGB REIT, now this is IGB REIT, right? This is IGB REIT, and you can see their base fee is 1.0, performance fee 5% of their net property income. But okay, but if you look at a Al Arca Capija REIT, base management fee is only 10 times less than IGB REIT manager, and they all have no base performance fee. So what do you think? I mean, is it, you know, really better to actually invest in a REIT that has a lower management so-called REIT manager fee, or how would you take it? Down comments below. Okay, now that being said, I think this is all I have for this Capija Al Arca Capija Healthcare REIT. So this is a really long list of things, which I think the most important thing is that you might want to review their property portfolio if you haven't already. For me, I've already reviewed this, because we review this every few months, or even at least every year, as we update what we have for our REIT method members inside the paying members inside my REIT investing course, which is at reitmethod.com. You can check it out below, reitmethod.com. But these are the things that, you know, I already compressed this video into a short one, because really you can actually check out the other video as well, similar dissecting REIT annual report. You can access REIT and all that. So just stay on until the end of this video, where, you know, there will be a pop-up to say that you can actually check that out for that annual report, what like exactly this video but in more detail. So that being said, if you enjoy this, give it a like, and if you find this useful, click on subscribe so you get notified when I publish more lessons like this. Comments below, ask me any question if you have, and that's all I have for you. This is CF Liu from CF Liu channel and from reitmethod.com. I will actually see you in the next lesson. Okay, you have a good week ahead.